Good morning. Welcome to Stock Market Today. It's Tuesday, February 16th, 2021, and I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider upon further work. You should always do further work. Hit your inbox every trading day before the market opens. So U.S. equities were higher on Friday heading into the 3-day weekend, and the major market ETFs closed at record highs once again. At the sector level on the day, energy, materials, and financials were the best performers. Defensive sectors, comm services, and discretionary lagged the broader tape. Treasuries were mostly weaker with the curve steepening. I'm talking about this for months. This shouldn't be surprising anybody at this point. Dollar was stronger against the yen and the euro. Gold finished down 20 basis points, and crude oil continued that rally, closed up over 2% on the day on Friday. Now, as we get to the desk this morning, some moving parts, some puts and takes. S&P futures are up about 40 basis points, and I am recording this at about 6:30 a.m. That rally in the S&P futures is on the heels of European markets mostly trading higher, and that follows broad strength in Asia overnight. In particular, the Hang Seng in Hong Kong and the Nikkei in Japan outperformed. I will point out that the markets in China do remain closed for Lunar New Year, but the rest of Asia, as well as the rest of the world, just kind of off to a good start. Treasury yields are up about 2 basis points, so continued weakness in price, right? Inverse relationship between the price and the yields. And the curves are steepening around the world. We saw curve steepeners on Monday in Europe as well. Dollar is weaker against the euro and sterling. However, it is up against the Japanese yen. Oil is trading higher. Gold's trading flat. The industrial metals are somewhat mixed on the day thus far. And I wanted to broaden things out here a little bit. So this chart looks a little bit different because it is different. I'm using weekly closes, right? Line charts, weekly closes going back 5 years. I think it's fine to paint the picture of what we want to say here. Simple fact of the matter is these are uptrends. Okay. The trend is up until proven otherwise. I know a lot of people, I've been reading a lot of work about sentiment being frothy, how the retail trade is a sign of the market top, how the explosion in things like Bitcoin is the sign of a market top, how, the explosion in interest in all things Cathie Wood and the ARK funds are the sign of a market top. And you know what? That very well may be. But if it's not, it's going to be painful to continue to bet against this trend until it reverses. Remember what trend following is. Trend following is, by definition, there has to be a trend to follow, right? So calling tops is futile. People have been calling tops for weeks and months now. Wouldn't a better exercise be to connect the dots? Zoom out a little bit, actually see that some of the major markets around the world are just emerging from 2, 3, 5, even 15-year bases. That's interesting to me. Dollar weak. I wouldn't expect to see that at a market top. Yields, we'll look at treasuries, treasury prices a little bit later on via TLT. Yields rising, prices falling on treasuries. Not exactly what you expect to see at a market top. The point is, it's just guesswork. And, if somebody who's been calling a top for 3 or 4 months, right, if the market corrects 5% from here, are they right? They're not. They're not. The trend is up until proven otherwise. The support levels. I'm not going to rehash them here. And I'm being a little overly dramatic, but that's to prove a point. Isn't it easier? You think about swimming. I used to sail. Sailing applies also. Isn't it easier to go with the tide and go with the winds as opposed to fight them? And when you're sailing, right, sailing in the direction of the tide with the wind is a lot easier than going against those two dynamics. What's the tide here? What are the wins? I think it's a pretty simple concept. Everybody wants to be a hero and call the top. Not my game. Let's hit our market in a minute now. On top of everything else, leadership is concentrated in the right sectors. So we'll talk about that. Defensive sectors continue to lag the broader tape. You've seen that one for a while. Long bonds are under pressure, as I said, not what you'd see at tops. We're going to screen for leading stocks and leading sectors this week. And as I said, futures point to a higher open today. Quickly run through them. The power bars look great. Dow up 11 basis points, 10-2. S&P up 52 basis points on Friday. I mean, we're greater than 4-1 bulls to bears on the S&P. NAS greater than 3-1. I'm small caps greater than 10-1. Although they were an underperformer on Friday, so there's that. Bonds down ticked, sending yields higher. Energy, your best group. Oh, yeah, energy 4-0. According to the Chaikin Power Bar, small cap stocks and large cap stocks are strongly bullish. Indexes are mixed. Let's hit that screen now. Pretty simple. In my note today, I have a bubble chart where I look at Chaikin relative strength overlaid with deviation from 20-day moving average. And what's interesting to me is the four leading sectors, comms, energy, financials, and tech, are all kind of right at or very close to their 20-day moving averages. So I said, that's interesting. Let's use those as a starting point. So those four funds are a starting point in a screen where we look for very bullish and bullish stocks with strong money flow, strong relative strength, right? You know, basically our bread and butter, you know, motherhood and apple pie for us here at Chaikin Analytics in terms of a process, what we're looking for. Bullish stocks leading the market, under accumulation. Well, within those four sectors, we have 29 stocks that pass the test. Some of these, you know, are names that should be familiar to a lot of people, right? For those of you who read my market survival guide, ExxonMobil should look familiar. Intuit is a name that I've highlighted on multiple occasions, right? We've touched on names like Micron and semis, right? In general, but we've touched on the banks. How many times have you heard me talk about the banks getting better? Look at, how about Avago? I mean, a lot of quality names in here. Across the groups, though, it's interesting. It's interesting because it's not just this concentration anymore of, you know, tech and comm services leading the charge. There's leadership. Citi. Okay. Ameriprise, right? Ray J. RF. You know, so some leadership. It's fascinating. So take a look at that. Screenshot this. You know, look at a name like ExxonMobil. Now, they are overbought here in the near term. That is the one caveat. A lot of these are going to be overbought. But, I mean, look at a name like ExxonMobil, right? Bullish, and then it gets in gear. And now you have just a nice pattern here, working higher highs, higher lows off those, off that November trough. So take a look at a name like that. Let's look at our sector tracker now, moving in the last 5 days. When we talk about the right kind of leadership, this is it. I mean, energy, tech, comms, fins at the top of the list, industrials, healthcare, middle of the road, right? And you have your staples and utilities at the bottom. I like to see discretionary perk up here a little bit, but it is what it is. We play the hands we're dealt, and we play them to the best of our ability. But for all intents and purposes, this is the right kind of leaderboard. Not a lot to say. It hasn't changed all that much. As a matter of fact, I'm writing my note today and my sector rotation note, and just there's not a ton to say different. The trends are in place. The right kind of sectors are leading. Leadership is broadening. It's hard, you know, I guess it's hard for me to paint a super bearish case here. And maybe that's the bear case. Maybe the bear case is that it's hard to paint the bear case, but we'll let price dictate if this is in fact the top. Industry and focus today, speaking of energy, oil and gas, equipment and services, XES, ticker symbol there, outperformed the S&P by 19% over the past 6 months. Pitching a shutout here on the power bar, 4-0, bulls to bears. Pump, National Oil, Well, Varco, and NEX are very bullish respectively. Holdings of a fund that looks very much like that ExxonMobil chart, quite frankly. Rating turned bullish in December. Shortly thereafter, the fund begins to outperform. That's when we changed our view. Pretty simple concept, right? Not dogmatic. We were energy haters for a while, and then it didn't make sense to be an energy hater anymore. Bullish fund, outperforming, strong trend, strong money flow. Really the only issue I see here is overbought in the near term. So certainly an area where we want to go looking for ideas. There's no two ways about that. Let's look at the movers and shakers now. Friday's trending names in the S&P 500. Illumina earnings, Mohawk earnings, send those stocks higher. TER, another semiconductor company. Mosaic, how long have I been beating the drum on ag and ag plays? Mosaic up 5.10%. Didn't see anything company specific to drive the trade there. NASDAQ, Disca, rather, neutral stock up nearly 5%, nothing company specific. Loser side of the board, top three are all earnings related. DaVita down 7.3, Newell down 7, and Digital Realty, DLR, down 3.3% on the heels of their earnings announcement. UAA, nothing company specific on Friday, but they did announce earlier in the week, so maybe some follow through there. And Ralph continues to just be a mess of a company. Ralph Lauren. It's a shame. It's an American icon, right? A traditional American brand. Who doesn't know polo? But doesn't mean the stock's good at the moment. Neutral stock here down 2.4%. Didn't see anything company specific to drive the trading in that name. Let's hit it now, right? It's Tuesday. It's relative strength day. In particular, sector relatives. Every day is relative strength day here at Shaken. It's a major part of our process, right? You hear me talk about it all the time. I beat the drum. In fact, I beat the drum so much that I go as far as to say that, our 20-factor model is a great starting point for idea generation. But, you could have a bullish stock if it's lagging the market, right? If the relative strength's not there, tough to get paid. Market has to agree with you. And until it does, until the market agrees with you, any investment you have where the market doesn't agree with you is an opportunity cost. It's capital tied up where it could be put to more productive use. So let's take a look. But, again, look at the defensives. So you've seen this chart numerous times. Utilities, plumbing to new lows on a relative basis, below the 200-day moving average. Real estate, a little counter trend rally, but not enough here to get me excited yet. Real estate is somewhat interesting to me in that maybe people are paying attention to it because it was so beaten down at the troughs of the pandemic that you could be getting some good yield. And if you have confidence that dividend yields are safe, and you're selling your treasuries because treasury yields are ridiculously low, maybe there's some rotation. I'm just kind of thinking out loud here, trying to build a framework. It doesn't matter because the trend is still down for REITs on a relative basis. So I'm not going to overthink it too much. The trend is down. If we do turn higher, then I'll change my views. And look at XLP. Look at Staples on a relative basis. Again, new lows, right? So your defensive sectors are underperforming, right? Now contrast that with your offensive sectors. Energy, right? Above a 200-day moving average on a relative basis, right? So XLE relative to SPY, 200-day, and 200-day beginning to flatten out. That 200-day has been declining for more than 2 years. Starting to flatten out? Fascinating. We're above it regardless, right? It's an offensive sector, cyclical. How about fins? Same story. Declining 200-day, now rising 200-day. Ratios above it. These are offensive sectors. And tech, just doing its thing. Steady Eddie, uptrend above its 200-day moving average. You get my point. So you have defensive sectors lagging, offensive sectors leading or turning the corner, all while more long bond lows. Take a look at TLT, trading at the new lows. Has a very bearish rating, by the way, at Shaken Analytics. And look at TLT below the 50-day. The 50-day has been a nice guide. So maybe we're a little overdone here in the near term, fine, but still very much a downtrend. And TLT lags AG, AGG, broad bond market proxy. That'll wrap us up. Take us for that test drive. Great to be back after the weekend. I'll talk to you tomorrow.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.